Hi, I'm Anup, and I welcome you all to Blue Saffron, the podcast program of corporateshitak.com, sponsored by Jani Plastics. And you're about to receive knowledge on Indian and Australian GST, goods and service tax. Yeah, you got it right, mate. Let's get started, shall we? Benefiting from ITC, the input tax credit is the darling of every GST registered businessman. The tax paid on inputs as the purchase of goods or services or capital goods is called input tax, and the credit obtained on that tax is called the input tax credit. Before the ultimate consumer pays the GST, the tax passes through several hands of B2B, business to business. The Government of India is committed to her promise of collecting the same tax that the ultimate consumer pays. Therefore, the GST system makes sure of not levying tax over tax, except for some special notified cases where certain sinful products such as tobacco leaves, whose regular consumption have cancerous effects on the human body. Such products have excise duty as well as GST. The idea behind double taxing is to discourage tobacco leaves consumption for the beady smokers. I don't know why the government hasn't put the alcohol under GST for that matter, because it too causes harm to the human body, isn't it? Now, simply speaking, the only way to avoid double tax is to give away the tax collected back to the person other than who is not GST registered one. This stops the cycle at the end consumer. This is why the end consumer bears the ultimate burden of GST, leaving no scope for him to avail input tax credit. Let's understand this via a real-life model of Jani Plastics as a medical device component manufacturer. It caters to the medical device manufacturer, who in turn caters to the healthcare industry. And the ultimate consumer, therefore, could be the patient waiting on his bed to have his plaster cut soon. So, in order to avoid double taxation, the GST Council has devised an instrument called input tax credit. So, simply speaking, the Jani Plastics can claim the tax back, the very same tax that it paid while purchasing the raw material. Same way in the business course in the cycle, the medical device manufacturer can claim the tax back, the very same tax it paid to the medical device component manufacturer, in this case it's Jani Plastics. The medical device manufacturer sells the devices to the healthcare industry, which can claim the tax back through this input tax credit instrument by charging the patient, and the patient has no way to avail the input tax credit. Now, there are certain key points to remember with regards to ITC. It's available to every GST registered person, but with certain conditions. What are those? Credit is only for input supply used in business courses, not for personal reasons. Credit is available only if the output supply, that's your sale, is taxable. GST exempted items are not creditable. Credit is available only on 4 GST subtypes, namely the CGST, Central GST, State GST, the Integrated GST, and the Union Territory GST. Credits of CGST cannot be used to pay SGST or UTGST and vice versa. In other words, you cannot mix the central tax with the state or union territory tax, all right? Credits of IGST, on the contrary, can be used to pay all the GSTs and vice versa. Isn't that good? Credit balance can be carried forward indefinitely. The full 100% capital goods purchase credit is available in the same financial year. So you don't need to split that over 2 years anymore. Friends, I'm talking about the capital goods here, which could be the machinery. So when you are purchasing the machine, you can claim the input tax credit back within the same financial year. Even if not paid to the seller, you can still claim ITC by just producing a purchase document, the tax invoice. However, you need to pay to the supplier within 180 days. The ITC must be claimed before filing GSTR 3 for September next year and GSTR 9, which is annual return. Now, there are some documents you need for ITC. That's the tax invoice of input supply from GST registered or unregistered supply, bill of entry, debit note, input service distributor invoice or credit note. Now, what is input service distributor? We'll see that in a different podcast. Inward supply tax credit can be availed only when outward supply is made from the same category of certain items such as health services, the cosmetic and plastic surgery, beauty treatment, catering, outdoor, foods and beverages. Now, ITC is prohibited for certain items such as membership of club, health and fitness centers, and the travel business, the travel benefits extended to employees for vacation. So, my dear listeners, I hope you enjoyed the audio. I also hope there was some takeaway for you. Signing off now. We'll come up with more interesting episodes. Till then, take good care of yourselves. Keep liking your one and only Blue Saffron. Cheers. Bye bye.